Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 16th, 2022. It is 10:17 a.m. Eastern Time. I'm starting the video, and I'm going to go over just kind of a eclectic mix of things. Won't be super long. I know I say that, and then it usually is, but I want to just do an update on the equity markets, Treasury bonds. I got those out to you today, so I won't spend too much time there. Gold, silver, pretty much those are the two posts I got out to you today. So if it's not clear or hasn't been clear from the videos and the charts I posted in the last 2 days, it's pretty much right now at this moment I think we're in a risk-off environment. But that gets tricky because the old risk-off assets, again, I've been warning about trying to put too much into old relationships and really focus on trading everything on their own technicals. You know, stocks and bonds used to move inversely, then they were moving positively correlated, and then, some days like today, bonds are up and stocks are down, so it's like no rhyme or reason. All right, let me just go over those charts to show you my thoughts. This one, I've caught up on some of the comments. I went back from the last about 4 or 5 posts and went through the comment section to see if I've missed any questions or comments or replies. The two that I missed, number one, somebody asked for an update the other day on semis, and I'm kicking myself because I meant to. I saw something a couple days ago. I meant to put it in a video, and I left them out. Sometimes if I don't jot it down on my notepad, I'm like this one, I'm just doing kind of off my head. I don't have any notes for this video, but I definitely wanted to start there. Okay, this is SOXX. This tracks the Philex SOX Semiconductor Index. That's the original. If you go to SOXX.X on TC2000, that's the original semiconductor index. That guy you can go back to all the way into the 90s when semis really started being a big thing back there. And so you can chart the index itself, and that's and SOXX is just the ETF that tracks the Philex Semiconductor Sector Index. So you can see this is our primary bull market uptrend line. You can play around with it a little bit. You can come in tight right here. You can capture that spike low back when that was the COVID drop right there, and that's probably the one to use. And then you have this secondary trend line right here. And I can play around with it. There's been so much volatility in recent years to get these big spikes, but I think that's the best one to use right here. And that comes in about the 2015, 2016, what I refer to as a deer market. Now, I didn't make that term up. A deer market's really neither bull nor bear market when something goes sideways for a period of time, although you did have two nice corrections in there, but it was a period of, you can see here, the year breaks beginning of 2014 all the way until mid to late 2016, where the stock market and the semis went nowhere. And again, I think it's a level to use. So we'll look at that as our secondary trend line or minor trend line, and then this is the longer term primary. So, and it's still a target I think the semis are coming to, and I think they'll actually have a good chance of breaking it ultimately. But either way, we just hit it and bounced. And remember, we bounced, semis bounced when the market bounced. SOXX, let me just spend time on the daily chart here for you real quick and show you what that I wanted to cover the other day. And it's really not too late for this. Go back to the ETF itself because that's what I have marked up. Here we go. All right, so remember, although I was a bit skeptical of this one, I pointed out all the reasons the market could rally and shouldn't, and including the semis, and it did rally. And again, I kind of did that whole mea culpa video the other day, just saying I should have been aggressively long. Profited very well off both of the bear market rallies we've had so far this year, and this one, especially right here, I got caught on the wrong side of it, shorting, and so whatever. You don't get them all. Nobody bats 1,000. I'm still having a great year, but I'm just kicking myself, both personally and on the site, not being more adamant that when we had those bullish engulfing candles on not just the indexes, not just the S&P 500, the Nasdaq 100. You see it here in SOX. In the strategy, the typical MO, what I usually do when you see an extended bottom, positive divergence, and I said this in that video, is just take it on face value. It's one of the best RR trades out there. Just like I love island cluster bottoms, because the strategy, as far as, again, RR, risk versus return, when you see a bullish engulfing candle or any type of candlestick reversal pattern like an island cluster bottom, then you just have a stop at the lows, because if you take out the candle, then it's no longer a bottom, and so that would have served well. And remember, they're not short-term trading patterns. They mark tradable bottoms. Now, we've had a heck of a run. Let me just say this. So that's over. That's hindsight. I can't go back in time, and it's about a 34% rally. We are in a bear market, number one. So I'm showing you right now that this may be, at the very minimum, I think it's a significant top. We're going to have a tradable pullback in the semis. Yeah, it already started today. Again, shame on me. Meant to do this one the other day when I saw it running up to this target zone, but we're down 3.4, but there's more downside to come in my opinion. Okay, so that's number one. So if you're in the semis, you rallied into this minimum target zone right here was from this trade, went long the semis back here, and that was again minimum, meaning looking for a move at least up to there, and if not up to that next level, which we hit 424.59. And now, the fact that it was resistance back then, it's still resistance. When you look at this daily chart, you have these lines right here, reactions all back here. And of course, you had more reactions here. You had more reactions there, gaps. A lot of gaps in there, a lot of reactions from below. Then you broke out above it. You back tested successfully. Then you broke it here, went back tested once more from below. Remember, resistance once broken becomes support, and then support once broken becomes resistance, and boom. So it's every bit as valid back then, and it's a target zone. A target zone or support or resistance zone is an area when I have not one distinct line, but a couple lines in close proximity that are really more of a zone of resistance, not a hard level. So the bottom line is we hit the top of that zone. Not just that, we hit the 200-day exponential moving average, which you can see here. Usually defines bull and bear trends, especially in tech indexes and in sectors like the semis. It's bullish when they're above, bearish when below. You broke it here. I just went to a weekly chart. Here's so again, there's so much to see in this one chart. That's why I do these videos. So in addition to everything I just showed you, horizontal price resistance, you have the primary downtrend line right here off the highs. That is the bull market high. That was the end of a great bull market right here. Say what you want about it, but the semis dropped from there 47, almost 48, yeah, about 48%. You can see the pop-up box to the left. So a 50% drop, I think that qualifies as a bear market, right? I think we'll all agree on that. And so you have a confluence of resistance. You have the primary bear market downtrend line. You have the 200-day moving averages, which support it in an uptrend, and when you break them, you're in a downtrend. And traders usually step in just as they did here, just as they did after you broke it there. That's where they step in and sell. Rallies back to the 200, especially in a bear trend. Now, look. I'm showing you all the levels and the reason why at least, I keep saying at least a tradable pullback here. But this works the other way. If you are a glass half full guy or gal right now, thinking this market's just got a lot more upside to go, and it's going to go there pretty quick, then yeah, you look for a breakout, a solid break. Now, I would caution you to wait on a weekly. I would look for a solid weekly candle, maybe even two above that resistance level. This was also my weekly chart. Remember, I gave you targets on the daily, but on the weekly was T1 right here. That was again off the highs. I listed pullback targets on the semis, and we hit it, and as expected we bounced up to S1R1. That means support / resistance. So that is still the next, it's now our resistance level, about 435.83, but this is even bigger resistance, and that's it. So, and I still maintain my next downside targets on the NASDAQ 100 semis. That was another question I replied to in the comment section today. Somebody asked me what are my thoughts on 401k monies. Remember, I'm not in the business. I used to be, but I'm no longer in the business of giving any individual investment advice. I'll tell you what I'm doing. This website to me is just kind of a journal. I'll tell you what I'm seeing, what I'm trading, how I'm positioned, how even if I'm not positioned on something, how I might be. Normally, if I like it, I'll throw out a trade idea. So, not everything that I throw out here I have, because sometimes I cover 50 stocks or 30 stocks in a video, or different sectors. But for the most part, if I'm tell you I'm bullish on something, I'm either long it, or I plan to be long, or I was long. That's what this thing's about. Oh, so back to that. So my reply was, somebody asked, they were thinking cash, and what my thoughts on bonds. Well, I got the bonds out to you today. I told you that ZB and TLT just hit resistance, and they have some negative divergences building. So at least a near-term pullback, but I still think the RR, the risk reward, is more favorable for bonds forget about very near term. I'm talking intermediate term, weeks to maybe months, more favorable than the stock market. And they asked about money market funds. Everybody, all these folks out there, and again, I used to be in the business. I used to give this advice. They chide, money markets as being a bad investment. Money market accounts. In your 401k, you either have, usually most 401ks, either cash, which is a money market or stable value fund, bonds, which can be government bonds and or corporate or a mix thereof, and then stocks, and that can of course be large, medium, small cap, international. But those are the three asset classes. And cash, we'll say a 401k is a long-term account. You should never have it in there, especially in an inflationary environment. You have negative real rates of return, meaning you're earning right now 2, maybe 3% at best on a money market, and inflation's running at 7, 8. But I say this, if, and again, everything's conditional. If I'm right in the stock market, whether it's this year or next, we're going to make new lows, which I still believe at this point in time. That may change, but as of now, then my take is it's a whole lot better to make 2%, 3% tax deferred on your money, even if you're losing after inflation, than to lose 20% on equities. It's very simple to me. So, in bear markets, what happens is the folks that just tuck in and go to cash, they come out ahead. They might be losing after inflation or barely breaking even, but it's a whole lot better than the folks that rode out a bear market and saw their 401k drop by 50% or so. So that's my thought process there. And I'm sorry to get off on that tangent. It's kind of, I didn't want to forget because I wanted to. That was a good question in my opinion. And again, at the end of the day, that's just my 2 cents. And that may change. I may be singing a different tune. If we start breaking out above resistance levels, it should contain pullbacks. So there it is. If I didn't give you enough on semis, and still again, you can see on SOXX, this is a beautiful uptrend line on the semiconductor ETF. Comes off the 2008 lows in the bear market right there. Lots of clean, distinct reactions, and to me, this trend line here is a magnet. There's two things I'm looking at. I'm looking at the pre-COVID highs right there. I think February 2020, right before everything fell off a cliff, including the semis, and the trend line, they intersect. And so from my experience, when you see very, very well obvious defined support levels, and you get this close to them, it's almost like a black hole or a magnet. You hold two magnets together or get them close enough, and then they kind of just snap in. Same thing with a black hole. Its gravitational pull is so strong, even light can't escape it if it gets close enough, right? And so that's usually what happens with a stock or a sector. And again, we came close, but in my opinion, not close enough to satisfy that as a tag. So I still maintain that we're probably coming down here. And to me, it's a matter of, are we going to go up a little more first and then get there, or is this it? And so I just want to say that there's good chance, because we're in a bear market, and everything I just spent the first part of this video telling you about, all these resistance levels, moving averages, price resistance, trendline resistance, and I got one more for you if that's not enough. Good old Fibonacci resistance. This is the entire move from the all-time high back in, this one looked like it peaked, the semis peaked in December right here. Had this big drop down here into the recent lows, and we just hit to the button, the 38.2% Fibonacci retracement level. So, you're likely to get sellers to step in there, even if you're going to go higher and run at the 50%, which is again lines up perfectly with that reaction high and that other resistance level I gave you before. So this is really my preferred. This could be it here. Right now, there's a lot of momentum in the market. I'll say that. That they've been marching out the bull parade on TV, and at the end of the day, if they get the masses fired up enough, believing that it's over and we're going to have a Santa rally and all this stuff, and it's supply demand that moves the market. So we could, the uptrend could continue. At least a little pullback here. We could see some upside into the end of the year. I think if we don't get rejected here soon, if this isn't the end of it, look, let's keep it simple. Another way to put it, if we pop the recent highs, especially, let me say this, especially after a decent pullback, because we're pretty overbought right now. Overbought can become more overbought, but for the bullish case, would be a nice little correction, maybe back to about this level right here. something like this to work off the overbought conditions and then build up some energy to power up to that next run up. As of now, I'm not looking out that far. Like I said, it's hard for me to get hardcore bearish, like as in load up on the semis and throw away the key for the next leg down. I just can't say that now. Again, from everything that happened, the put to call ratio, the equity, at least the equity put to call ratio. Remember, one of my several sentiment indicators, and the AAI bull bear spread got pretty high too. So some of the sentiment indicators reach levels that mark significant bottoms, and of course that's playing out. But others yet, majority of my indicators haven't, telling me that again, this bear market rally was pretty well telegraphed, but it doesn't appear to me that this is the end. So that's what I'm looking at, guys. Hopefully that makes sense. So near term, I'm going to give you that level. There's a pullback target for the semis that want to swing it down, and that's right about 350, 354. And this guy has the short versions, SOXS. Tracks the Phillips, I believe the same semiconductor sector, if I'm not mistaken. It used to. They may have switched. I know it previously did, and then I think at some point this company switched to another index. But either way, it's a basket of semis, and there's SOXL, the bullish one. So again, if you want to buy an ETF that shorts it, it's SOXX, but it's 3-time leverage, and there's others out there that don't have leverage, and there's other one times. Let me move away from that. So I don't want to spend too much time on the semis, but just pointed out that they were at pretty good resistance. Now let's get back to the market. QQQ. Remember, we put in divergences all the way from the 60-minute time frame recently out to the weekly time frame, and as I've stated repeatedly, that's the most bullish technical setup I've seen in many years, and it's playing out so far for a rally. But again, what is most likely a bear market rally? And my target zone, as I covered yesterday, is up in this area. But we're at the minimum target zone right now. We're still probably more upside. If you're going to be long right now, or the one of the more conservative strategies, a long short. I said this a few weeks back, even back here a couple weeks ago, that long tech, short energy is probably the best pairs trade I can think of for the stock market. XLK is your tech sector, and you can see, I forget where exactly I said that, but that was in one of the videos recently right here. So about a 15% run just in the last, not even 2 weeks there. And XLE still hasn't rolled over hard yet, but it's gone virtually nowhere since then. Mentioned it breaking down here, pushed up, made a marginal new high, and we're still rolling over. We've got the bearish PPO crossover. I've showed you in the past what happened since the bear market started. Every time you had a bearish PPO crossover, I don't see any reason why this one won't be the same. And I want to show you something, another update on crude oil. So I showed you yesterday we had a 60-minute divergent low right here, and that was good for this trade. Then I posted an update first in the comment section for a pullback short trade, and that's playing out so far. But bigger picture is this. Here's crude oil. Let's go to a yearly chart. And let's zoom it down a little bit. Maybe we can do 6 months. Let me see what I've got on here. Yeah, there it is. So here's an uptrend line now that's been broken. You can also see that. So that was broken, back tested with a brief overshoot, and we're below that uptrend line. You can see it here on the daily chart as well. Go to 6 months. No, we'll just keep it on a 1-year daily candles. So here's kind of the big picture on crude. So there's the downtrend line right there. Let me change tools. There was an uptrend line. We had a little false breakout. These were just divergences on the 60-minute chart, all those DHDLs. But you can see we're below this trend line right now, and that would mesh with a bearish case, because it's the energy stocks have been holding up because crude and nat gas have been holding up. But when you look at nat gas, I just flipped over. I'm on a 60-minute chart now for natural gas. Remember this trend line? We had a trade here recently. Remember we went long on this bearish, bullish falling wedge breakout with divergent low, popped up, hit our first target there, pulled back. We've been stair-stepping higher, stair-stepped our way up to T2. T2 was right here, but we gapped up that morning. It was a Sunday night. Futures opened up. When they do, they close on Friday, and they open just like stock futures, and they open up on Sunday evening. And so if you had a limit order there, that's where you would have been filled. And then we've been bouncing off this trend line, bounce, bounce, bounce. But look, today broken. So this now we're at price support. So really, if we can go much lower, take out today's lows on natural gas, about, I have that number at about 5.728 right there. It's pretty darn good support. And you can see that we've taken out a pretty darn good trend line. One, two, well, almost two, three, four, five, six, and reactions to validate it. Now it broke, but you have what I call BOD, or benefit of the doubt support. So if we get this in natural gas, and then crude continues lower, that energy, that's one of the most crowded trades right now. I love shorting crowded rush for the exit trades like tech. That's why I pressed the NQs and initially the small caps down. And I think you're going to see the same thing. Every fund manager, every institution's chock full of energy stocks right now. Those that are allowed to. So many funds have gone green lately in recent years and received a lot of pushback. Even pension funds and all that for holding anything that God forbid any gas, oil, or gas stocks. But with that being said, there's still a lot of folks in there, and again, the case is technically it's a strong case. You've got a double top high, you've got negative divergence, you've got a overcrowded, I think, an overowned trade, just like the big FANG stocks. That's why they took the market down so hard. They were just overowned and overloved, and when that happens, there's only you've got everybody and their brother. There's no one left to buy. When everybody's bullish on Meta and Amazon and Alphabet and Apple, which is think late to 2021, early 2022, who's left to buy when the last bull is about his or her share? So that's why you get those stuff. That's why people can't put their head around. Most people just couldn't even fathom in the beginning of the year that Amazon, would drop. What did it fall down to support here? 55, or 50%, that over 50%, and that's it. It's a couple things. Fundamentals change, and then the future outlook of the company. But again, it's more so you just have a lot of forced selling, margin call selling, growth funds that say no longer meets the criteria of the growth stock, blah, 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 blah. Okay. All right, enough on that. I didn't want to ramble too much, but so the case for a pullback in the equity markets, Amazon is being one of them. Remember, this is a top component of the S&P 500 and Nasdaq 100. I told you this was a big level. We bought it here, 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 even though we shorted all the way down there, traded these rallies, and then when it broke that, I said I give it a very good chance it would hit my next target if and when that 101.45 level was broken. We came very close. Again, I've already covered this. It's mere percentage points, not basis points, but I think it was, what is that here? I'm just curious myself again to grab it. If I grab next to there, well, do it this way. You can grab the bottom of the candle. See, I got it there. And put it on that line. That was exactly 2.2% or 2, depending how you move the line. So yeah, again, close enough, and they stepped in, and I've always said this, if you're targeting a level, if you're short or you're looking to get long on a pullback to support, then you don't put your order in to cover at 83, 84. You always cover a little bit above. And so they did. They bought it. Now they rallied back to what was very good support, excellent support, and support once broken becomes resistance. So that's where we're at right now. And so there's two scenarios here. I mean, there's always an infinite number, but number one, that this was a bear market rally, and we had divergence, and that divergence would project a lot higher, but in a bear market, divergence often plays out for either nothing at all or a much smaller rally than it would in a bull market, and you rally back to resistance. So we could go down and make a full tag of that 83, 84 level, or even worse. You look down and over time, Amazon, let's not forget the biggest picture. When I go to this weekly chart here, it's probably easier on this monthly chart. Here's Amazon since it came public. This is my BOD, or benefit of the doubt, my lower trend line off the all-time lows, when the stock came public, and comes in, and we're below that. So this one broke trend, and it's below all these trend indicators. So That's it, guys. You're in a bear market, and like I said, I wish I had more stronger convictions whether we're going up. Like I said, there's a lot of momentum right now in the stock market. They seem to be buying the dips. They seem to believe that the Fed, and that's another thing. I think they've market is overpricing any ease. At best, the Fed's going to slow down. I believe they will slow down the rate cuts, but rate hikes. But they're not going to cut anytime soon. So you're still going to have the free money. The punch bowl's been taken away. That doesn't change at the next meeting. Probably get a half point, and they'll maybe say they're wait and see kind of approach. But now you're still talking interest rates. The free money's gone, and it's already broken a lot of companies. They attributed that to what broke FTX. There's so many companies that were flourishing on pretty much free money. And although we're still, and I know the bull case, we're still at relatively low interest rates. They're, if you look back historically, but the thing is, this is TYX, a yield on the 30-year Treasury bond. We've got to go back here, and I've done this many times. Here's where we're at right now in bond yields, and we go back all the way into the early 2000s. That's what this is undone. This whole thing, in one fell swoop, in a matter of just since the COVID lows, we've seen interest rates go from near zero all the way back to where they were back in the early 2000s. Now the problem is too, we were in a much lower, we were in a regular non-inflationary environment back there, and now we're in a hyperinflationary environment. So over time, this is going up. My outlook remains near-term bullish for bond. Very near term, as I told you today. I'm looking for a little pullback. That's just very near term. Intermediate term, I still think we're going to see interest rates come back in, long-term bond rates, which will cause bonds to rally. Remember, bonds rates and bond prices go inverse. But then longer term, I believe by it's not just a hey, I want to believe because we have inflation that it's going to be permanent. No, there's so many factors, including but not limited to these secular bear trends in interest rates that we were in. We're coming off a 40-plus year secular bear market, and it ended with a blow-off bottom, just like a blow-off top. And you look at like the dot-com bubble, for example. You go to the NASDAQ Composite. This is what a blow-off top looks like. You go parabolic at the end right here, straight up, and then that was followed by like an 80% or so. That was about an 80% bear market. Blow-off tops don't end well. It's more healthy in advance when you have a more steady climb, and this was only a 55% bear market. And so where I'm going, the same thing happens in reverse. So you look for parabolic moves, parabolic advances. And parabolic advance can be to the upside, i.e. a blow-off top, or can also be to the downside. That's a selling climax. And so that by every metric I've ever used in technical analysis and what's going on right now in fundamental analysis, meaning economics macro picture, says that marked the end of most likely a secular bear market. And there's going to be rallies and pullbacks and things along the way, but we're probably looking at an inflationary environment for years, if not decades to come. And again, you overlay, and I've done this, the S&P 500, stocks like falling interest rates. And so it's no coincidence you're coming off one of the largest secular bull markets in history, especially going back to the mid 70s, really where it all started when inflation peaked. Inflation actually peaked right there in the early 80s. And so that's just going to give headwinds for the bear market. And I don't mean to be doom and gloom. I actually welcome it, because one thing about bear markets is the bear market rallies are explosive. A bear market rally in just a matter of a month or a couple months, maybe 2-3 months at most, sometimes 6 weeks, you can make more easily, 20-30% in just a couple months, which is, almost double or triple, depending on what period you look at, the annual returns of the S&P 500. And you don't have to catch all of that either. You just catch a good part of it. You're doing well. Take your money, tuck in, go to cash in your 401k or bonds or whatever, and wait for the next rally and just trade those rallies. So here's the thing about it. Whether I welcome it or not, you got to take what the markets give you. And so, it's a good time if you're not comfortable short selling. I get it. At least know when to tuck in and maybe not be have so much into equities. Maybe at that point, take some profits, raise your stops, go to cash. But that's it. So as I said before, the reason I've been bullish on bonds now for last few weeks. This is a monthly chart. Remember last month we hit the that big level. I have it about 40. It's about 4. 39.93 means 3.993. So that's 4% yield on the 30-year right there, and it was really good resistance, that major reaction high, and I can see it acted as support right here. And so we hit that, and I told you I suspected it would be a momentum fueled overshoot, which means when you have a lot of upward momentum or velocity going into a resistance level, you tend to overshoot it, and that's exactly what happened. Then you come back in, and now we're back below there. So like I said, I think we'll see, and you can see, overbought indicators right here. Look how extreme overbought we got on the monthly chart of the 30-year Treasury bond yield right there. Last time we weren't even that oversold, but that's where I have a yellow line, which is usually what does the trick at about 62.90, and then the red line is the traditional 70. But I always say when you're using an RSI, remember charting platforms by default are going to tell you 70 is overbought, but every security is different. If you look at this, going back as long as you want. Go back here. The last time, other than right now, that Treasury bonds, or the 30-year yield reached overbought readings was right here when the bull market ended in interest rates and the secular bear market started. See that? That's back. See my crosshairs, 1981. And so this is why I say you don't, kind of look at charts and don't go off what everybody else goes off. You have to look at every security and treat it differently. So with Treasury bonds, the magic number or overbought number is not 70, it's 62.9, and that's where we hit and the circles hit, and here's what happened. This is where if you're just a 401k investor, institutional investor would love to know this. Just look at something so simple. But again, if you're managing your 401k, you say, okay, well, when the 30-year Treasury bond RSI hits 63.90, that's about all that rally has got left in it. And so at that point, I want to go. Remember, a drop in Treasury yields gives you a rally in bonds. So that's when you want to be buying bonds right there. And that's what we did right here recently. And so, despite any near-term pullback or not, I still think we're going to have a decent correction here coming as Treasury bond yields fall. So I still, 401k stuff right now, that's, where I told you that's where, I've got a chunk of money. Okay, and let's keep an eye on crypto. Like I said, it's pretty toxic right now. If you're if you're aggressive investor, you want to be short if you want to engage it. Probably best to stand aside because the counter trend rallies are strong. But this is 110% bearish. There's nothing bullish right now in crypto, including the charts, the technicals, which we're looking at here. Again, Bitcoin's the leader. That's the big dog. Most institutions have Bitcoin. Ethereum, yeah, I understand the proof of work and all that versus now proof of stake. A better thing, but Bitcoin's still the gold standard for crypto, and Ethereum's down as well. They're moving in lockstep. But again, until and unless Bitcoin can take that level out, this is what we're looking at, and I covered this. So there's a downtrend line. We're down today. We're in a risk-off environment now. The stock market's down today. Crypto's down. Gold and silver, like I said, are kind of hanging in there, but I gave you a sell signal on gold today. I think probably get a little bit of a pullback because they tend to move up and down with the stock market lately. They've kind of had an on-off relationship, but this is a big thing, and again, it's both technically. 100% bearish when you look at it from a technical perspective, and fundamentally, I don't know how anybody could spin anything but bearish with the collapse of FTX, and it just goes to show the lack of regulation in that sector, and who do you trust when something's not regulated. And not only that, and then it's one thing that they lost all the clients' money by moving it over to their trading arm, but then to see that what was it, like 400 million or something, as they were trying to put a lot of those coins into cold storage, a bunch of them got hacked and taken, so that's less money coming back to the folks that had money at FTX. So. And that's going to should have a psychological impact for quite some time, just especially for, I think, institutions. You got your crypto bugs, the fanatics that have believed in it forever, or maybe just recently got on the bandwagon, and they're going to defend it no matter what, and they're going to buy it, and they're going to ride it to zero, just like AMC, and the apes and the Diamond Hand, those GameStop, those folks. Um, but institutions now, I have to question that. Let's just say you run a pension fund and you're responsible to pay pensions out to all the retirees in your system, and you have a decent stake of crypto, and all of a sudden you book a 80% loss. You're gonna have to defend why were you in such a speculative asset. So I think if nothing else now, you're gonna see some institutions kind of second guessing their positions, but who knows? And again, we'll see. We'll let the technicals tell us when it's time to get back into crypto. But right now, this is not good, and it's also not good for the overall stock market. Remember, the shoes, and just kind of loop back. I know I told you I'd just ramble on this one, kind of go on different tangents. The shoes that haven't yet dropped, we've had several, including the crypto bomb, we've had the gilt bomb over in the UK, and the big one that I still think is yet to come, and it should be coming soon, is private equity. Private equity, who gets to kind of mark their own assets to what they think it's worth, and it's a known fact. It's about a 6-month or 2-quarter lag. I studied this very carefully. I looked into this, dug into endowment funds from colleges like Harvard, and Harvard probably did better. They did do better than most of the rest, and they've lightened up. But a lot of these endowment funds, public pension funds, they were knee deep into private equity. That's what they've shifted into. And when I look at the returns, they're not jiving anywhere close to the stock market. And so either private equity all of a sudden is just all facets of it are all geniuses. They're all grossly outperforming the stock market. No, I say when the stock market drops anywhere from 37 to let's say 30%, and you're telling me private equity has is -3 for the year overall? No, that just hasn't been marked down. So when that gets marked down, there's going to be some problems, and sooner or later they're going to have to mark those assets to what they're worth. It's kind of think a lot like real estate. Think about your house. You're going to look at your Z estimate. Your last Z estimate told your house was worth 600,000, so you're happy you paid 3 a few years back, and you're at 600,000. And the Z estimate this month might have gone down a bump, but guess what? All of a sudden, three weeks from now, your neighbor sells, and he sells for 400,000. All of a sudden, and then another one goes. That's when comps run, and all of a sudden, your Z estimate's going to go from 600 quickly down to 450. I'm just using an example. Maybe don't hold me to those numbers, but that's what's going to happen there. So that's still another shoe to drop, I believe. And pension funds, once it comes out and they report their actual returns, once they recognize those losses on public equity, private equity and other hard to value investments like real estate and whatnot, because that's where a lot of they've shifted to in recent years. And again, that's what's buoyed up the returns to the point that I am very confident is being grossly under reflected, the amount of losses so far. And then when that gets recognized, then there's going to be talks that these are already underfunded. They've been underfunded for years, most of the public pension funds, and that's where a lot of them. I'm talking about it because there's a tremendous amount of money in those, and it's going to have a big impact because when they have a shortfall, they promise their retirees X amount when they retire per month or per year. It's got to come from somewhere, and you have states like California. CalPERS is the largest, so I pick on them often. California is already an extremely repressive tax state, with their state income tax on top of federal taxes, and that's only going to get worse because somebody has to pay for it. Somebody has to pay for the teachers and the firefighters who are promised X amount when they retire, and it sure isn't going to be there from their investments. So anyways. All right, that's just a bunch of rambling fundamentals, kind of longer term stuff. But most importantly, it's just, we're at a minimum bounce target for the NASDAQ 100. I gave you yesterday potential bounce targets. The NASDAQ's been the weaker of the two indexes compared to the S&P 500. S&P 500, I also gave you comparable bounce targets, which should load any second here. There we go. And again, so we're at the minimum levels, and like I said, it's hard to say. I don't have very strong convictions. I am probably coin toss odds whether we're going to go up. This I would put, obviously the red box is where I think the most likely. So down, the most likely maximum bounce would be up to around that downtrend line. Um, this is, I could still see the potential for this. I put lesser odds, but that would still be a bear market rally in my opinion if we got all the way up there. I don't think we're going to get that high in the S&P, but it's certainly possible because if you look at where the S&P is now and how much it would have to go to get there, that would be another 8%. And then you look at QQQ, which it's lagged, and now the tech stocks are playing the game of catch up, and they had the more constructive charts. So to go to the top of the red zone here, my red box, which is the downtrend line and the 200 simple moving average, that's about 10.3. And remember, the Nasdaq 100 has a more higher beta. It tends to go up more when the stock market's rallying, and it tends to go down more when the stock market falls. Obviously, it hasn't caught up to the S&P. It's lagged behind, but then that's what would probably happen if we're going that high. So that's it in a nutshell. I see at best right now, say another 10% upside the market, but almost as much of a chance as I see that happening. I see this may be it, because that's how bear markets work. Just when everyone thinks they're safe to get back in the water, that's usually when it smacks the masses in the face by turning around when everything looks rosy and volatility's low and charts are constructive. And so, like I said, I'd put coin toss odds that we could drop from here or go up there. And I know that's not very useful for timing things if you're trying to nail, all full long or full short position, but you don't have to do that. Again, you do what you want. I just provide an analysis. My thing is to scale in here, scale out of longs into shorts, and if you start scaling in right here, let's say into swing shorts, and we just start going down from there, you continue to add to those. And especially when you see us getting close down to the bottom, and you take out any uptrend lines from the lows. The way it works is, any pullback should be contained. You can use Fibonacci retracements. You can look at price support levels. And if we go down, like a fib retracement, you would put up, let's say, here's the whole move up from the bottom right now. So a healthy pullback would be contained anywhere in these between this 38.2 fib right here down to the 61.8 fib. So that would be a normal correction pullback. But you take out the 68 fib and you start to take out key support levels along the way, like this gap right here, and that starts to bring into question this near-term uptrend that started right here. See right here, you have so that's what would get me to start going aggressively short when we start taking out these levels, support levels, and the fibs. And of course we get anywhere close to those lows, I think the market will just crater. I think it'll become apparent to all that the rally is over. But until then, there's still a lot of stocks coming off divergent lows and constructive charts. So it's really a mixed bag out there now. And I'm going to end the video here because I've just been talking. But the takeaway is, when I look at individual stocks and even the different sectors, I pointed out some that look very bullish still, some that are just coming off lows, some just breaking out, and then others that are looking very frothy and looking poised for a pullback. So I think it'll be a stock picker's market, at least from now to the end of the year. And you might get grind around a bit trying to trade only the indexes if you don't know what you're doing. So I probably, I'll revert back to active trading mode, where I trade off the 5 and 10 minute charts and things like that. Here's a 60-minute chart of NQ. Like I showed you yesterday, we had the divergence there, that trend line, and then that big 11,785 support. That's been broken. So I think we're going to continue lower from here, most likely. You go down to 10-minute chart, however, and we may get a bounce because you probably have some divergence now. Yep, right there. There's divergence. So the way it works, it just This is what's been working for me for a while, for most of this year. Just looking at these 10-minute charts, and you have a breakdown. Yeah, is that bearish that we took that level out? But then if this 10-minute divergence plays out, you're going to recover it, and then you're going to go up. And you just have to adjust and adapt. If 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 you are an active trader, this is your time frame, the 10, the 5-minute charts, coupled with the 60s. I'll say I'm not covering yet because divergence is not a buy signal, and I don't see there is a little reaction low there. But by the time I stop this video in a minute here, I'm going to look at that, and what I'll do is I'll probably lower down the stops real tight and usually layer out, so it takes me out if we start to bounce. And then if we recover that level, it may have me stopped out. If I have enough stops overhead, I can put the way interactive brokers work. So if you have 20 contracts short of NQ, and you layer it out, let's say 888 or 10 10 10. You're stopped out of the first 10 contracts and the next 10 contracts, and then the next stop is hit, and that puts you long 10. So you can actually, that's the good thing about it. You can put an order that is above the position size you have, and that's why I often talk about reversing. If I'm short on something and my target's hit, and I think we're going to bounce, then my short's covered, and that same exact execution puts me, long that same position. That's what so I don't. Not all brokers have that. It's just a feature interactive brokers has. So makes it easier. So you have one trade to close and reverse instead of two separate trades. All right, I'm going to wrap it up here, and all right, we'll see if anything else stands out. I'll get it to you. But right now, that's what I'm looking at is probably a little weakness in gold and Treasury bonds near term, weakness in the stock market near term, but if they rally it back up here, and get it back above that level, we could certainly see another leg up in the market. But for now, I'm favoring a little more downside in the stock market because we took out that 11,785 level, and I think that opens the door. I'm going to give you one more level right here where they're probably going to step in and buy when we get there, and that's right here, 11,621. Because you have two reaction highs right there. That was a divergent high. Then they broke out and back tested it right there. They tested it again here. And so if we could just clear out this previous reaction low, we're probably going to thrust on down there and likely see the buyer step in for at least a bounce, especially because at that point in time we're down 1.45% right now, and that tends to be about it when you have a lot of upside momentum. You get about a 2% drop, the buyers are usually going to step in and gobble things up. And then if we're below that level, a back test to the 11, a little shy of the 11,784 level would also offer another objective short entry. Because remember, we're coming off a big divergent high here on the 60-minute chart. And so, as I showed you before, there's a potential. I think there's a decent chance, not great, but a decent chance of coming all the way back down to back test the primary downtrend line right there. And that's going to be, if you shorted up in here and the rally to resistance, I'm just going to grab in that area there. That's going to be a drop of roughly 7%. That'd be a nice pullback trade. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.